Stocks are near all-time highs, yet confidence is low, volatility is high, and nobody feels relaxed. Bad news makes markets go up. Good news makes them go down. People are making money, but they don't trust it. That's not normal. Markets don't usually feel like this unless we're at the edge of something. Let's start with the feeling, because if you're watching this, you've probably felt it. You hesitate to buy, the market rips. You finally buy, it dumps. You sell to be safe, it goes higher. You chase, it punishes you. It feels personal, like the market is one step ahead of you. This isn't just volatility. This is disorientation. And historically, that only happens during transitions. We've seen this before. Late 1929, late 1972, late 1999, late 2006. Before big regime shifts, markets stop making sense. In 1999, stocks went up on losses. Valuations didn't matter. This time is different was everywhere. The Nasdaq went up 400% in 5 years. Then it fell minus 78%. Amazon dropped minus 94%. Cisco dropped minus 89%. Not bad companies, bad timing. This isn't about fear, it's about excess meeting reality. Here's what makes today more dangerous. The excess isn't just retail, it's concentrated and systemic. The Magnificent Seven now make up about 36% of the S&P 500, 7 stocks holding up the entire index. In 2000, the top names were closer to 18%. We are double that. NVIDIA recently traded around 70 to 75x forward earnings. That's not valuation, that's expectation. At the same time, equal weight S&P is flat. Small caps are struggling. Over 40% of stocks are down 20%. The market looks strong. Under the surface, it's fragile. This is the real problem. The market is addicted to liquidity. For more than a decade, rates near zero, money printer go burr, risk always rewarded. Every dip was bought. Every mistake was forgiven. That trained behavior. People don't invest anymore, they react. Now, even small tightening causes chaos. That's why margin debt is still near $700 billion. Zero-day options are 40% of options volume. Volatility spikes on random headlines. This isn't long-term capital. This is leverage chasing dopamine. Markets don't feel rigged by accident. They feel rigged when algorithms dominate. Positioning matters more than fundamentals. Speed beats patience. The market isn't reacting to earnings, it's reacting to flows. Who's forced to buy? Who's forced to sell? Who gets liquidated first? That's why moves feel violent and explanations come after the fact. Here's the part people underestimate. The most dangerous markets aren't crashes. They're sideways emotional markets. Markets where big crashes don't happen, big rallies don't hold, confidence slowly erodes. This is where people overtrade, abandon discipline, chase noise, and blow up quietly. This phase can last years, just like 1968 to 1982, just like 2000 to 2013. Smart money isn't loud. They're not predicting dates. They're not screaming all in. They're reducing leverage, increasing diversification, holding cash without shame, and letting volatility pass. Cash isn't bearish. Cash is optionality. It's the ability to act when others can't. So, is a crash coming? Maybe, maybe not. That's not the point. The point is this. When markets stop making sense, risk management matters more than predictions. This isn't a market for heroes, it's a market for survivors. Something is very wrong with the markets right now. Not broken, not doomed, but stretched, addicted, emotionally unstable. And markets like that don't reward confidence. They reward patience, discipline, and humility. The goal isn't to be right, it's to be still here when clarity returns, because it always does. Please subscribe to my channel for more videos.